Well, back on the markets for more on Europe and what is going on in the equity markets. We are joined by our guest, Joseph Tanious. He's the market strategist at JPMorgan. Also, Sarah Eisen with me, who's been tracking what has been going on with the euro. And Joe, you know, Sarah and I were watching what happened with the euro. I mean, some wild swings going on in that market, in the currency market.
In 24 hours.
Yeah.
24,
what did you make of that?
Well, I think you're seeing a sort of this broad risk-on, risk-off trade. There's a lot of uncertainty in the year coming ahead as to what's going to happen in euro. Obviously, you're seeing the European economy slip into a recession. If it's not in one right now, we think it'll be in one shortly, and that's certainly having an effect on the currency.
But the currency has remained so strong all year. Why now is it breaking down?
It's interesting. You know, I think if you think about the sovereign debt crisis and what that's meant for the currency, it's actually been somewhat neutral so far because you have a lot of investors pulling money out of peripheral European bonds and putting that into the German bund. And so if you think about it, it's been neutral. But now as you're seeing the European economy head into a recession, I think there you're starting to see an effect on the currency.
Okay, so Europe then is going to continue to be what, the #1 negative factor for the equity markets going into 2012?
It's hard to say. I think we'll have a lot of distractions in 2012, and Europe will probably be one of the biggest ones. In addition, obviously, to what's going on in China and what's going on here in the U.S.
Okay, so what's your outlook then for 2012?
Our outlook for 2012, we think that broadly speaking, the equity markets still look attractive, and we think there's an opportunity there on the back of stronger earnings.
Which equity markets? Here in the U.S.?
The U.S. equity markets, Let me be very specific. The U.S. equity markets, we think the earnings will continue to grow, but probably at about a 5 to 6% growth rate rather than maybe the 17% growth we've had over the past year.
Has the European recession been factored into the markets, both there and here?
Great question. And yes, it has. I think if you look at a European recession, you ask yourself what effect that's going to have on the U.S. economy. We only export roughly 2 to 3% of our GDP into Europe as a whole. So even a very severe European recession won't have a huge impact on the U.S. economy. What concerns us, however, is if the sovereign debt crisis continues to grow and deteriorates even further, what effect is that going to have on the financial markets? And obviously, that spills over to us here in the U.S.
It's a banking crisis.
Well, I think it can become a banking crisis. The ECB has certainly taken steps to enhance liquidity and stop this crisis from spreading. What we haven't seen yet is a solution to the underlying issue, which is sovereign debt. You have to see greater fiscal integration in Europe, and we have to see the ECB take a bigger part in the sovereign debt market.
But here's the problem. I mean, because I hear that a lot, which is that Europe is not going to impact us. Numbers. I mean, technically speaking, I mean, as you say, the exports are quite small, but why do we care about the Italian debt auction, right? Why do we care about what is going on in some of these smaller markets? It's because it's all about psychology, right?
Correct.
It's all about sentiment. That's what it is.
Systemic risk in the financial system.
Absolutely right. Absolutely right. If this continues to deteriorate even further, and if financials in Europe continue to take it on the chin, ask yourself, what does that mean for our financials here in the U.S.? We are certainly globally integrated, and as financials here in the U.S. get affected, what effect does that have on consumer psychology, consumer spending?
Right.
And there you go now.
And do you think, Joe, that with these numbers, and it seems like the numbers are better than expected, let's put it that way so far, for some of these retailers, is that going to translate into a more bullish stock market economy?
I think it certainly could. If you think about what's going on in the retail space right now, and just broadly, the economic data we've had here in the U.S., it all suggests that the economy here in the U.S. is picking up pace. And so this is all constructive heading into 2012.
Okay, constructive. However, there were some warning signs also with the retailers, and you had some that didn't do so well, like Sears, for instance, also Best Buy, a lot of deep discounting. So what does that tell you then about retailers themselves and whether or not they're good bargains at this point?
Well, I think you are seeing better than expected retail sales, but at what cost, right? You are seeing margins begin to compress.
Yeah.
That certainly have an effect on earnings moving forward. I think broadly, as we look at retail stocks and retail space, we continue to be cautiously optimistic on cyclical sectors and retailers and discretionaries being one of them, of course. But we do think it's also important that investors take a step back and realize you're entering what may be another volatile year, and investors should position themselves accordingly. You want to look at higher dividend-paying stocks and things of that nature.
In which sectors, though, exactly?
Well, I think as you think about higher dividend-paying stocks, you do in fact have consumer staples. You've got utilities. You should think about having a well-balanced portfolio across all 10 sectors. Now, if you ask me where we have the most conviction today, I would tell you technology. That really hasn't changed. Remember, last time we spoke about this, we continue to believe technology stocks look attractive. We think there's a secular growth story there on the back of all this cash sitting on corporate balance sheets. And as far as what to avoid, we're still a little bit cautious on financials heading into 2012, given everything that's going on in Europe.
But avoid financials completely?
No.
Or, okay.
No, I think you definitely don't want to do that. If you take a look at where valuations are right now in financials, it's hard to ignore them, right? They're very, very attractive. And I think if you are, in fact, a long-term investor, we're talking 5, 10 years out, you have to realize that this issue we're dealing with in Europe is at some point going to pass. I can't tell you when,
right,
but we're at some point going to find resolution and financials should rebound. If we talk specifically about 2012, what we think will be another volatile year, I think financials, as they've performed this year, may in fact lag the broad market.
Well, because we had a fund manager on yesterday, Doug Sandler, who said, look, you know, he's nibbling at financials, but he's not talking about the Goldman Sachs's and the Morgan Stanleys of the world. What he's talking about are some of the ancillary financials, you know, that might be taking some market share away from these firms. You know, he was talking about American Express is one of his picks. Does that make sense to you?
Absolutely. I think you want to be very selective when you go into financials. You certainly do not want to avoid them, given the attractive valuations, but this really calls for active management. I think you want to have a manager who's picking up these stocks using a bottom-up security selection process. You know, you've got a lot of moving parts in financials, a lot of uncertainties as it relates to regulation and how that regulation is going to be interpreted. There are certainly going to be a few gems in there.
Joe, what gives you that conviction in technology? I keep hearing that over and over again with our guests, that tech is sort of the big, you know, it's going to break out in 2012. Is that what you think as well?
Well, I would maybe temper that expectation is going to break out in 2012, but I would say broadly, if we look at all the sectors and how they'll perform in the S&P 500, I think we've got some conviction in tech. You've got some very attractive valuations. There's certainly no question about that. I think if you take a look at all the cash that's sitting on corporate balance sheets in the S&P 500, I think you've got roughly $2.5 trillion worth of cash right now. There's pent-up demand in spending and capital expenditures, and if you look at where companies typically deploy that, you'll notice that roughly half of that money ends up going into technology of some sort. So we do think that tech will be a large beneficiary of all this cash and all this dry powder sitting on the sidelines.
What area of tech, though?
I think tech specifically, very broadly.
Okay.
Again, you're looking at a sector where I think it's important to have bottom-up security selection.
All right, Joe, thank you for dropping by.
Thanks for having me.
Joe Tanious of JPMorgan.